Debt market update, June 2022. The 10-year GSEC yields moved within a limited range and ended the month at 7.45%, 3 basis points higher vis-a-vis last month. The energy prices, especially crude oil, volatility in US yields, growing concerns on global growth outlook, rise in policy rate by RBI by 50 basis points, etc. were the key drivers of the GSEC yields. The short end of the curve moved up more and thus further flattening the curve. Corporate bond spreads over GSEC widened but remained lower than historical average. Average net interbank liquidity declined sharply month on month, driven by US dollar selling by RBI and payment of advance taxes. Further, the full impact of hike in CRR rate by 50 basis points to 4.5% was felt during the month. FPI sold net debt worth $0.2 billion in June 2022, as against net inflows of $0.4 billion in May 2022. Cumulatively, FPIs have sold debt worth $1.6 billion in H1 CY22, vis-a-vis net seller of $0.3 billion during the same period last year. Outlook. The surge in yield since the beginning of CY22 has been driven by multiple factors, including large government bond supply, lower RBI intervention, elevated inflation, acceleration in monetary policy normalization globally, etc. This was further aggravated by Russia-Ukraine conflict, which impacted the energy, commodities, and food prices significantly. RBI, which was maintaining supportive monetary stance till FY22, moved towards normalization in April 2022 and followed it with 40 and 50 basis points rate hike in May and June 2022, respectively, as it was increasingly concerned about persistently high inflation. However, MPC minutes released for June 2022 meeting were relatively dovish compared to market expectations. Going forward, elevated energy prices, resilient CPI and WPI, accelerated tightening by major global central banks, etc., are likely to put upward pressure on yields. Further, RBI is also expected to continue to hike rates and is likely to pause when there is increasing visibility over inflation softening. The high SLR holding of banks, along with large government borrowing program, is also likely to adversely impact yields. However, over the past month, factors supporting lower yields have also emerged. Firstly, there is emerging concern about the global growth outlook, and risk of recession or slowdown in US and other advanced economies has increased. Consequently, commodity prices including agriculture have corrected substantially from their peak, and if the trend sustains, that could ease inflationary pressures. Moreover, risk of fiscal slippage has reduced in view of the recently announced measures to impose tax on exports of oil and auto fuels. These should help mitigate the shortfall in revenues due to higher subsidy outgo and lower RBI dividends, hike in CRR and expected widening of current account deficit, and consequently negative balance of payment in FY23 is likely to lower aggregate system liquidity over time and thus could open space for conducting OMO purchases by RBI in the second half of the year. On an overall basis, we believe that balance is still skewed towards yields trading with an upward bias. We derive comfort from the fact that the adverse factors are prevalent for some time now, and the impact of the same has been priced in, to a large extent, in the current yield levels. Further, there are certain positive developments, which if sustains, bode well for yields. In conclusion, in view of the heightened near-term volatility and expectations of continued flattening in the yield curve, we recommend staggered investments into short to medium duration debt funds. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.